Oil prices are climbing, markets are rattled, and energy companies are quietly panicking. Russia's response to U.S. sanctions may have just triggered the most dangerous energy confrontation in years. What comes next could change everything. The story behind today's energy confrontation doesn't begin with Russia's counter-sanctions. It began years ago, when the war in Ukraine forced global oil markets to scramble for new supply routes. Western leaders responded with sanctions designed to squeeze the financial power behind Moscow's military machine. Two names quickly became central targets: Rosneft and Lukoil, Russia's largest oil producers, together responsible for nearly half of the country's crude output. At first, Russia shrugged off the pressure. Rising oil prices actually boosted profits, and Moscow rapidly redirected exports from Europe toward Asia, especially China and India. Analysts called this a geopolitical pivot, an improvised lifeline to keep revenue flowing. But here's where things get interesting. As prices cooled and sanctions stacked up, the stress began to show. Revenues fell sharply, profits dropped, and a $10 discount on Russian crude, compared to Brent, became a painful leak in the economy. Washington then tightened the screws again. New sanctions froze assets linked to Rosneft and Lukoil, blocked American companies from doing business with them, and threatened secondary sanctions on foreign banks assisting Russian oil sales. Suddenly, refiners in China and India backed away. The shock was immediate. Moscow's markets fell. Oil jumped over 5%. Surprised? You should be. In response, the Kremlin signaled it would not remain silent. Russian officials warned of countermeasures targeting U.S. energy interests, framing the move as economic self-defense. Critics in the West argue these counter-sanctions risk further destabilizing global markets. Russian analysts, meanwhile, accuse Washington of weaponizing the dollar and energy trade. So what's truly at stake here? Not just barrels of oil, but leverage, credibility, and geopolitical influence. As both sides escalate, millions of ordinary people feel the ripple through fuel prices, inflation, and market volatility. And this raises a serious question. If neither side backs down, how far could this energy confrontation really go? With Washington freezing assets linked to Rosneft and Lukoil, the Kremlin has now answered in kind. Russia's counter-sanctions target selected U.S. energy firms that provide drilling technology, offshore equipment, and financial services connected to oil trading. Assets held by these companies inside Russian territory are temporarily frozen, and their access to licensing and joint venture projects has been blocked. To Moscow, this is not retaliation, it's reciprocal protection. Legally, Russia is invoking national security emergency powers, tools strengthened after earlier waves of Western pressure in 2014. These statutes allow the government to intervene in foreign-owned assets and restrict corporate activity without lengthy debate. In other words, enforcement can happen quickly and quietly. Russian officials claim the move defends strategic industries and shields domestic producers from external economic aggression. State media frames the decision as balanced, pointing out that the West set the precedent by weaponizing trade. Critics inside Russia, however, warn that such steps risk scaring off investment and accelerating economic isolation. Meanwhile, American analysts dismiss the counter-sanctions as mostly symbolic, designed to rally domestic support rather than inflict real damage. But here's where things get even more interesting. The uncertainty alone is powerful. Companies caught in the crossfire may pull out of projects, delay shipments, or shift operations to third-party countries. That means slower investment, fewer jobs, and more market volatility, not just in Russia, but in partner economies as well. So, what have we learned? These counter-sanctions may not cripple U.S. firms, but they deepen the psychological and financial pressure shaping global energy flows. Looking ahead, experts warn that more aggressive measures could follow if tensions rise further. And this raises a serious question. Is the world witnessing temporary posturing or the early stages of a long-term energy war? Global oil markets hate uncertainty, and these sanctions just lit a fuse. Suddenly, pricing, supply routes, and investor confidence all feel shaky. For everyday people, this means higher fuel costs and pressure on inflation. But here's where things get even more interesting. On Wall Street, energy stocks swing wildly as traders fear tighter supply. Funds quietly move to safer assets, hinting at deeper worries. In Moscow, markets brace for impact. The ruble slips, and officials promise stability. Critics say Russia's energy-heavy economy is a vulnerability. Supporters insist years of sanctions have built resilience. We've seen this before. From the 1973 oil crisis to 2014 sanctions, every shock reshaped global politics and prices. China explores discounted Russian crude but risks secondary penalties. India enjoys cheap oil yet can't afford to upset Western partners. Meanwhile, the EU speeds up renewable plans, though skeptics argue progress is slow. Surprised? You should be. Higher shipping costs strain supply chains. Airlines and manufacturers feel tighter margins. Consumers, frustrated at the pump, pressure politicians. Supporters of sanctions call them necessary. Critics warn economic warfare can easily backfire. This raises a serious question. How long can global markets absorb this pressure before something snaps? As nations reposition, one thing is clear. The global energy map is shifting fast. So, are we witnessing smart adaptation or the quiet prelude to a larger crisis ahead? As sanctions and counter-sanctions escalate, the battle isn't just economic, it's informational. Global media outlets frame the story differently, shaping public opinion and political pressure. Some portray Russia as defiant and dangerous, others accuse Western powers of weaponizing finance. And caught in the middle, ordinary citizens facing rising costs. But here's where things get even more interesting. Russian state media argues these sanctions are a hostile attempt to weaken its sovereignty. Western commentators counter that they're necessary to limit aggression. Critics on both sides warn of propaganda creeping into headlines, fueling polarization. Historically, similar information wars emerged during the Cold War, when narratives mattered as much as missiles. Today, social platforms amplify rumors, conspiracy theories, and nationalist rhetoric. Governments quietly invest in digital influence campaigns. The battlefield has moved from oil fields to news feeds. Industry analysts warn biased coverage could spark panic in markets. Human rights groups fear misinformation may justify harsher policies. Meanwhile, political leaders use media pressure to rally support at home. This raises a serious question. If every side controls its own truth, how can the public find the real story? So, where does all of this lead? At stake is more than corporate rivalry or diplomatic pride. It's the stability of global energy markets, and indirectly, the wallets of millions. As sanctions harden and counter-sanctions hit back, governments and markets are preparing for several possible outcomes. One scenario is escalation. Russia could tighten energy exports further, pressuring Europe and driving oil prices up. Western allies might respond with even stricter financial bans. We've seen similar spirals before, most notably during the 1970s oil crisis, when political standoffs triggered economic pain worldwide. But here's where things get even more interesting. Another possibility is fragmentation. Nations like China and India may deepen direct energy ties with Moscow, bypassing Western systems entirely. That could accelerate a divide between energy blocs, reshaping the global order. Critics argue this could weaken international cooperation. Others say it finally breaks Western dominance over energy finance. A third scenario? Quiet negotiation. Behind closed doors, diplomats could seek limited deals to stabilize prices. But will both sides trust each other after months of political fire? This raises a serious question. Are global powers willing to sacrifice economic comfort for strategic pride? Investors warn prolonged tension may trigger supply chain bottlenecks and inflation spikes. Consumer advocates worry households will face rising fuel costs. Meanwhile, tech analysts suggest a surprising angle. Economic pressure might accelerate the world's shift toward renewables faster than expected. What you think about this? Must share your thoughts in comments and subscribe for more information. Thanks.